All right, welcome back. If you survived the first episode of Doc versus IRS series, where we talked about the doc who tried to be a rock star, buckle up, because today we have an even better one. So today the patient is another doc. No bueno, my colleagues. And this one decided that the best way to keep up with his continuing medical education was to fly to Khartoum, Sudan, and Dubai, and London, and spend almost 14,000 bucks on a CME conference in his home country, where his wife and his infant daughter happened to be living there at the time. He also deducted $18,000 in rent for his home office in his own condo. A home office he could not, when he asked, explain how he calculated. And he drove 30,000 miles a year between his condo and his hospital and tried to write off every single mile as a business expense. When the IRS politely declined all of this, he went to the tax court. And the tax court was even less polite. So, welcome to the second episode of Doc versus IRS series. Today, we're dissecting Elbasha versus Commissioner, Tax Court Memo 2022-1. And I'm telling you right now, by end of this 15-minute dive, you are going to understand three things that will save you money and possibly your license. Number one, business deductions. Number two, Section 274 substantiation. And number three, accuracy-related penalties under Section 6662. So let's go. So our patient today is Dr. Mohammed H. Elbasha. He's a real doc, doc, born in Sudan, working as a contract emergency room doc at Murray Medical Center in Chatsworth, Georgia. That's about 177 miles round trip from his condo in Atlanta. So in 2008, he got married. His wife stayed in Sudan. In 2009, they had a daughter. And his daughter and wife stayed in Sudan. And his wife didn't move to the States until 2010, following year. Meanwhile, Dr. Elbasha was working shifts in rural Georgia and tried to start a side business, an overseas physician staffing company. So he paid a broker named Sari Abdel Wahab to help him set it up. The broker never actually got him any jobs. So now here's the thing. None of what I just described is illegal or even unusual. So lots of physicians have family overseas. Lots of physicians try to start side gigs. And lots of physicians work long distance commutes to rural hospital. So the problem isn't what Dr. Elbasha did. The problem is what he tried to deduct and how he tried to substantiate it. So let's open his tax chart. So here's Dr. Elbasha's 2008 Schedule C, presented for your listening pleasure. So number one, cost of goods sold, $32,000, which was a payment allegedly made to the business broker. Number two, continuing education, $27,000. Home office rent, $18,000. Office expenses, $10,000. Interest, $2,000. Travel, nearly $15,000. Car and trucks, $20,000. So that is roughly $124,000 in business deductions in a single year. for a contract ER doc making about $68,000 in an adjusted gross income. So let me say that again because I wanted to land. So he deducted almost twice his adjusted gross income in business expenses. When the IRS sees a Schedule C where the deductions exceed the income, an alarm goes off, soft one. When the IRS sees deductions that are nearly double the income, it's not an alarm, it's a code blue. So audit team is running down the hallway with the crashy cart. So they audited him. He went to the tax court. And here's what happened to each one of his deductions. And I would like you to listen carefully because every single one of these is a lesson. So lesson number 1, a spreadsheet is not a receipt. So Dr. Elbasha's substantiation strategy was to make charts, a beautiful, organized, computer-generated charts. Monthly hotel expenses, monthly mileage, monthly office expenses, each one neatly summarized in a column. The tax court has actually addressed this exact move before. And the line is one of my favorite quotes in all tax law. The court said, a simple chart of expenses paid without documentation of the actual payments is not enough to substantiate the expenses. Translation, making the chart yourself after you've been audited in Microsoft Excel with no underlying receipts does not count. So think about it like this. So if a patient comes into your ER and say, Doc, I have a crushing substernal chest pain. I need a stand. And you say, okay, I need to see your EKG and your troponin and possibly stress test. And the patient hands you a piece of paper where he writes, my chest really hurts bad. Trust me. Would you will him into the cath lab? No. You would want underlying and real documentation, right? So IRS wants the same thing. The receipts, invoices, bank statements, credit card statements, not the chart, not the summary, not your sworn testimony that I definitely spent it. Lesson number 2. Section 274 is a strict substantiation bouncer at the club. Now we get into the real meat of today's talk. Section 274D, the strict substantiation rule. So most business expenses fall under Section 162, the ordinary and necessary rule we cover in episode number 1. So Section 162 says, was it common in your business and was it appropriate and helpful? If then, you get to deduct that expense under Section 162. But the Congress decided that some categories or expenses are so abuse prone that they need extra scrutiny. So they wrote Section 274D, which puts a heightened substantiation requirements on 4 specific categories. Number 1, travel expenses. Number 2, meals and entertainment. Number 3, gifts. Number 4, licit property, which includes cars and cameras and similar items. For those categories, you cannot just have a receipt. You need to prove 4 elements for each single expense. So number 1, the amount. How much? Number 2, time and place. When and where? Number 3, business purpose. Why? Number 4, business relationship. Who you were with and why that mattered to your business. Miss any of these 4 and the deduction gets disallowed in full. And here's a kicker. For Section 274 expenses, the Cohen rule does not apply. So let's talk about the Cohen rule real quick because it's a very important court case and taxpayer-friendly rule, in fact. So Cohen rule is a 1930 case that essentially says if a court believes you legitimately had business expenses, but you can't prove the exact amount, the court can estimate the expense, the net amount, instead of disallowing the entire amount. So it's a tax code's version of close enough. But Section 274 specifically blocks the Cohen rule. No estimates, no approximation, no judge believes me. It's all four elements or settle. This is why Dr. Elbasha's nearly $7,000 trip to Cairo got disallowed. He had a chart, but he had no receipts, no business relationships, documentation. And this is my favorite line in the entire opinion. The court basically said, he has not explained why it is an ordinary and necessary business expense for a doctor working in rural Georgia to attend a hospital business meeting in Cairo. Remember the quote, and don't forget that every expense must have a valid and reasonably valid business reason. Number 3, a CME trip to your home country is not a CME. This one is so important, I want every doctor listening right now to think about your last conference. Dr. Elbasha deducted nearly $14,000 for a CME course called Critical Care of Tropical Disease in Khartoum, Sudan, his home country. He deducted $12,000 for PractiMed Critical Care in Dubai. And he deducted $800 for a heart failure course in London. And now I want to be fair. Continuing medical education is genuinely deductible, and it is. Section 1.162-5 of the Treasury Regulations specifically allows it. And travel for CME is also allowed under Section 1.162-5E. And here's a catch. The court noted, quote, petitioner did not provide hotel receipts, airplane tickets, or any other evidence of the length of his trips. If a trip had a personal component, the amount of petitioner's deduction would be limited. And then the killer shot. Petitioner's choice to fly from Georgia to Sudan, his home country, where he has family, suggests a highly personal motive for his trip. So look, if you're a dermatologist and you happen to attend the CME conference in Maui the same week as your sister's wedding, the IRS notices. If you're a chiropractor and you happen to attend the sports medicine seminar in Aspen during ski season every single year, the IRS notices. If you fly to your home country where your wife and newborn daughters live and call it a CME, they essentially notice. So the rule is simple. A trip mixed personal and business purpose is only deductible if the primary purpose is business. And the burden of proof is on you. Hotel receipts, conference agenda, time spent in sessions versus on the beach. Document it like you're gonna be defending it. Because one day you might. Lesson number 4. The home office double deduction trap. So Dr. Elbasha deducted $18,000 for using half of his condo as home office. Half of the condo, guys. When the court asked him how he calculated 18,000 bucks, he couldn't remember. He didn't have floor plans. He didn't have square footage measurements. He didn't have photos. He just had $18,000. Worse, and this is beautiful catch by the court. He also deducted his property taxes, mortgage interest, mortgage insurance on Schedule A. So court pointed out in footnote that you cannot deduct the same expense twice. If it's already on your Schedule A as a personal itemized deduction, you don't get to claim it again as a business deduction. Lesson number 5. Your commute is not a business expense. Dr. Elbasha drove 170 miles round trip to Murray Medical Center. He deducted $20,000 for 36,000 miles in 2008. The IRS allowed about $6,800 for the period when his job was still considered temporary and disallowed the rest. So here's a general rule, and write it down. Commuting from home to your regular place of work is not deductible. Doesn't matter if it's 5 miles or 170 miles. Doesn't matter if you have a Honda or Tesla. Commuting is personal. So there's a narrow exception. If your work site is genuinely temporary, meaning expects it to last less than 1 year, your commute to it can be deductible. But the moment that temporary job becomes regular, the deduction stops. So Dr. Elbasha started Murray in mid-2007. By mid-2008, his job there was no longer temporary. The IRS gave him the first half of the 2008, and that was it. And on top of that, car and truck expenses are listed property under Section 274. So you need a contemporaneous mileage law, not the chart that you whipped up after the fact. So date, destination, business purpose, mileage, every trip. There are apps like Miles IQ, Stride. So there's no excuse in 2026 for not having a contemporaneous mileage law. None. So we get to the part that hurts the most, the accuracy related penalty under Section 6662. When the IRS disallows your deduction and assess additional tax, they don't just take the tax. They add 20% penalty on top of the underpayment if it's caused by negligence, disregard of rules, or substantial understatement of tax. Dr. Elbasha got hit with a nearly $9,000 penalty in 2008 and nearly $6,000 penalty for 2009. That's almost 15 grand in penalties on top of the back taxes, on top of the interest. Now, here's where every healthcare professional need to hear. Dr. Elbasha tried. I relied on tax preparer defense. He said, look, I'm an ER doc. I don't know anything about tax law. I trusted my guy. So court actually had a framework for this. It's called Neonatology Associates Test. It requires 3 things. Number 1, the advisor was competent, meaning an actual tax expert. Number 2, you gave him all the relevant information. And number 3, you relied on them in good faith. So Dr. Elbasha couldn't prove any of those elements. He didn't show his preparer was a CPA or EA or tax attorney. He didn't show what information he gave the preparer. He just said, I trusted him. And the court said, not enough, man. Penalty upheld. So here's a lesson. My CPA did it is not a magic shield. If you're going to rely on a tax preparer to escape penalties, you better be able to prove that they're qualified, you gave them everything, and you actually rely on their advice in good faith. Otherwise, the 6662 penalties can hit you anyway. So let me give you the surgical summary. Number 1, self-made chart is not substantiation. The IRS wants underlying documents, receipts, statements, real evidence. Number 2, Section 274 is a strict substantiation rule. For travel, meals, entertainment, gifts, and vehicle expenses, you need amount, time, and place, and business purpose, and business relationship. Miss one element, lose the entire deduction. No estimates allowed. Number 3, mixed purpose trips are dangerous. CME in your home country, conferences and vacation destination, research trips that look like family visits, document the primary business purpose and don't deduct it. Number 4, home office deductions. Remember that you cannot double dip between Schedule A, which is your personal deduction, and Schedule C, which is your business deduction. Number 5, commuting is not deductible. Track mileage contemporaneously and use an app. Number 6, the 20% accuracy related penalty under Section 6662 stacks on top of your back taxes and interest. And I trust my CPA is not automatic protection. You have to prove competence, full disclosure, and good faith reliance. So here's my final thought. Dr. Elbasha was not a froster. He was a hardworking ER doc with a family overseas. Try to build a side businesses, working with a trusted taxpayer. He probably did spend a lot of money on travel, on continuing education, on his condo. Some of those deductions might have been legitimate, but he could not prove it. In tax law, the burden of proof is almost always on the taxpayer. That's you and me. The IRS is presumed correct, and you're presumed wrong, unfortunately. So your job is to provide otherwise, with documents, with logs, with receipts. So if you take just one thing from this talk, take this. The time to win a tax audit is years before the audit happens. It's the day you save the receipt. It's the moment you log the mileage. It's the second you write the business purpose on top of the credit card statement. Document like you're going to be audited, because one day you might be. So lecture, we head to Colorado, where a dentist paid $50,000 for a trust strategy that earned him 41 months in federal prison. You're going to want to hear this one. So I'm out. Save your receipts.